A moving average will never predict the market, and if you use it that way, you'll lose. But it does one thing brilliantly. It tells you who's in control right now. Rising average, buyers, falling sellers. That read on the trend is the price action signal of the Confluence method, and it's where every swing trade starts. Plot a fast and a slow moving average. The slope of the slow one is your trend filter. When it's rising, you only look for longs. The crossover, where the fast average crosses the slow, flags a shift in control. It lags a little by design because it's smoothing noise, but that lag is the price you pay to stop trading every wiggle. In a healthy uptrend, the moving average acts as dynamic support. Price pulls back to it, finds buyers, and continues over and over. That gives the swing trader a repeatable plan. Instead of chasing the breakout, wait for the pullback into the rising average and buy strength there with your risk just below it. But know the regime. Moving averages are trend tools. Drop them into a sideways, choppy market and the crossovers fire constantly, everyone a whipsaw. If the slow average is flat and price is crisscrossing it, stand aside. The MA only earns its keep when there's an actual trend to ride. On a real chart, you can see both jobs at once. The slope tells you the trend is up, and each pullback to the average offered a lower risk entry than chasing. That's how a swing trader uses moving averages, for direction and for timing the pullback, never as a crystal ball. Here's the trade. The trend is up and the moving average is rising beneath price. Instead of chasing the highs, you wait for a pullback into that rising average. The entry zone here around 111, where price pauses and turns back up. Your stop sits just below the average near 108 because a clean break of it says the pullback has become a reversal. Your target is the prior high or a measured extension. You're buying strength at a discount with the trend at your back and risk clearly defined. The mistake that wrecks moving average traders, mechanically taking every crossover. In a trending market, the cross is gold. In a sideways range, it fires constantly, whipsawing you long and short until your account bleeds out. Before you trust a cross, check the slow average is actually sloping. Flat average, no trade. The crossover only means something when there's a trend for it to confirm. And remember where this fits. The moving average is your price action and structure signal. It answers one question: who is in control, and frames the direction you're allowed to trade. It is not a complete system on its own. You still bring a key level for location, momentum for confirmation, and a trigger to pull you in. Direction from the average, the rest from the stack. So read the slope for the trend, use the crossover as a heads up, buy pullbacks into the rising average in a real trend, and stand aside in a range. Direction and timing, never prediction. Stack it with a level, momentum, and a trigger, and you've got a real swing setup. Subscribe for the full method, and remember, this is education, not financial advice.